Hello, everybody, and welcome to the VRIC media channel. We are bringing the Vancouver Resource Investment Conference to you each and every week with our series of expert online panels. And I'm very excited for the one we have lined up for you this week. We have the authors of this book I'm holding right here, The New World Economy in 5 Trends. They're going to be discussing what these different trends are, how they will impact both the economy and investment decisions, and also how commodities and gold will play a role in these trends as well. So I'd like to welcome to the show Philippe Gijsels, Chief Strategist, and Koen, Chief Economist, both at BNP Paribas Fortis. Gentlemen, it's an honor to have you on the show.
Thank you for having us.
Thank you.
Well, let's get started by first discussing what drove you to write this book. What are these trends that you're seeing emerge, and maybe some implications for the commodities space? And then we'll go ahead and we'll go through them one by one and get your input there. And Koen, I'll start with you. You're going to cover the macro side of things today, whereas Philippe is going to be covering the investment side of things. So let's get started with the macro and what you're seeing with these trends in this new era.
Well, what I see is 5 trends that are going to define the macroeconomic and as well the investment environment in the coming, let's say, 10, 20, 30 years. And if I just go very fast over the different trends, then you see climate shocks, you see huge debt pile, you see the aging of the populations, and you see deglobalization, and all these 4 trends are inflationary. We'll have from time to time climate shocks, and Philippe will jump in a moment to talk about metals and metal shocks. Debt, high debt, how do you control it? Via a little bit of inflation. If we look to the aging population, there you know that if you have more consumers compared to the amount of people that are producing, this is creating inflation as well. And this is going to be the case in most industrial countries, except from the United States. And then you have deglobalization. Just imagine Donald Trump increasing, for example, it's the import tariffs by 10% for all countries and 60% in China. Yeah, we have calculated that this is going to increase and is going to give an inflationary shock of around 4.5% in year 1 in the United States alone. So these are just 4 trends that are going to be inflationary, and there is one trend that is disinflationary, and that is innovation. We have artificial intelligence, and we have quite a lot of other exponential technologies that we're going to talk about. And so I think, and we think, in fact, that inflation and higher interest rates are here to stay. It's not that now that COVID is finished, that we're going to go back to this era of around 40 years of ever lower interest rates and ever lower inflation. No, inflation is going to be structurally higher. It's going to go up and down and up and down. And certainly this is going to create an environment where interest rates are going to be structurally higher as well. So instead of being in the great moderation of the last 40 years, we're going to the great disequilibrium in the next 30 years. And this is going to have huge investment implications for investments. This is going to have huge implications macroeconomically as well. But now that we're really at the investment side, I give the word to Philippe or to you, Jesse, as you want.
Yeah, Philippe, please fill us in on, give us kind of a bird's eye view of these trends and how you're seeing them from an investment perspective.
Absolutely. So we will go into much more detail when we elaborate on these trends, debt and climate change and so on. And we will have plenty of time for commodities as well, because I'm a big bull on the commodities, especially on the metals, also the softs. We have some lofty price targets on it. We talk about 4,000 gold, which was very lofty not so long ago, but now a lot of people seem to have that target and even way more. And a doubling of the copper price, which was also a little bit ambitious not so long ago, but yeah, people come around to that view, and it all boils down, and we will look at the demand and the supply conditions of a lot of these metals later on. But the main conclusion of what Koen has been saying about, first of all, this world is structurally different as an investor, structurally different also as a company, where you of course have input the commodities as inputs in your business. You have the inflation for your wages, you have the interest rates. So all these things tend to go in the opposite way. So both investors and both companies have to be ready for this totally different world now. The way we see it, if you indeed have entered a period where interest rates and inflation especially are structurally higher for many years to come, this is an environment, and we will come back to that also in more detail, but this is an environment where you want to own real assets. And real assets are, of course, real estate, it's equities, it is pigeons, it is old-timers, it is wine, but also it is commodities. And then therefore we believe also that gold and then also especially silver and some of the other metals will clearly be a very good investment. They're under-owned, they're under-loved at the moment, because we all know, and then I regularly see your work. So a lot of people on your show talk about this, and we all know the people who follow this that the central banks that are buying. Investors are still not on board with the idea, the percentage point of gold and silver and commodities in portfolios is still extremely low from an historical perspective. So there is room to run. But the main message that as Koen has been conveying, and then I try to attach the investment implications. COVID was an accelerator, but a lot of these trends were clearly in place. This is a totally different world that looks more like the 60s and the 70s. This will be a time that fortunes can be made and fortunes can be lost. And we need to focus on real assets. And I believe commodities are an important part of that.
Very fascinating. Let's start with the first trend that you discuss in the book, which is innovation and productivity. Koen, you mentioned that's a deflationary trend. Maybe you could walk us through that from a macro perspective, and then Philippe will turn to you for the investment implications.
Yeah, I think that is the most positive element, of course, in our book that we talk about innovation. And as Philippe always says, yeah, okay, we need more wizards and wizards that invent things. Digital stuff, but as well renewable energy and all these things. And of course, the more that these things are invented, and the less that they are costly, the more companies are going to use these investments. Now, if I start at the beginning, what we see is that if you look to the digital economy, it has already doubled since 1995. Has doubled in total economy. And I think if we go and we increase on the same pace as over the last 25 years, probably we will see an economy where about 20%, instead of now 5%, 20% is produced by the digital economy. So digital economy is going to grow. It's going to be much, much more important than it is today. Now, the strange thing and the macroeconomic impact of innovation and productivity is, of course, economic growth is the amount of people that are working plus the amount of productivity that you can that is realized every year. Now, as you know, if we look to the developed markets, what we see is that the amount of people that are working is going to go down in the developed markets, except for the United States. So to compensate this, we will need to increase our productivity. Only what we have seen until recently is that productivity has not stopped coming down. It has come down enormously in Europe. It has come down pretty much in the United States as well, although it recovered a little bit over the past years. And how does that come? And if I just like to pinpoint that before diving into the new exponential technologies that I think that are going to flood the world in the coming years, that is what you see normally is that productivity is induced by process innovation. So innovation of a process, for example, electricity. Because of electricity, there was a conveyor belt. Because of the conveyor belt, instead of producing one car every hour, you could produce 10 cars every hour. What we've seen until now is product innovation. So better products, better digital products, and these products, what they have created, that is a lot of consumer surplus. We were very happy with it. I was very happy with WhatsApp and all these digital tools. But what you see is that it hasn't created producer surplus. And it's producer surplus that is going into GDP. It's consumer surplus that makes me and you happy. And a very simple example of that is, for example, if you see two encyclopedies. An encyclopedia, if you look to it, before there was Wikipedia, quite a lot of encyclopedias were sold. Today, no encyclopedia is sold anymore because everything is on Wikipedia. This is creating consumer surplus. I'm very happy writing a book because I can, if I would like to, I didn't do that, but I can copy paste everything from Wikipedia and I create a book. Before you had to buy an encyclopedia, and that went into GDP and that created economic growth. So that is a big difference. Just one more example to illustrate that. Look at our cell phones. Our cell phones, it has 20, 30 apps in our cell phones, and maximum cell phone cost at around $2,000, I think. Or you have to have a gold one, but normal cell phones, $2,000. Now, if you see how many tools that it has replaced, going from a phone to a GPS to a calculator there were more than 20, 30 tools. In total, the total production cost of these 20, 30 tools is calculated at $5,000. So we have produced something very useful, and that is the cell phone, a new product, but it has destroyed quite a lot of GDP because these other products, these 20 tools, don't have to be produced anymore. And so that is the reason why we see that productivity hasn't increased until now. So now we think that instead of only having a lot of product innovation, we'll see more and more of process innovation. And why and where do we see this process innovation? This process innovation is going to come from exponentially growing technologies. And which are these exponential growing technologies? First, what is an exponential growing technology? That is a technology that is growing at a pace of at least 10% per year for a couple of decades. And what are these examples then? That is, for example, artificial intelligence. That is, for example, 3D printing. That is, for example, biology, where you see mRNA and DNA analysis and all the other stuff. Renewable energy, for example, 3D technology. I was doing a presentation like this for a big crowd, and one of the people came to me afterwards and they said to me, it's strange that you come up with this 3D, because I'm a dentist, and until 5 years ago, no other dentist was saying, okay, I'm going to buy now a 3D printer. Now today, because of the reduced price, 50% of dentists were planning to buy or had bought already a 3D printer. This is what these exponential technologies are doing. The price of them is going down that fast that more and more companies and more and more people are going to buy these technologies. And more that these technologies are bought and are going to be used, the more that we will see that there is an increase in productivity. And why do I think, and then I leave the word to Philippe, and why do I think that we are on the verge of a big increase of implementation of these technologies? That is, if you look to history, there is one central element that always pops up before a big increase in productivity, and that is chaos. Chaos, be it war, be it COVID, be it climate transition, be it the Russian invasion in Ukraine, which makes us wanting to be much less energy dependent. All this chaos makes that companies, but as well the big governments, are going to invest hugely in this new kind of exponential technologies. And that is what is happening now. That is what I see now. And that is why I'm very, very positive that let's say between 5 and 15 years, that we will see an increase in productivity with about 1 percentage points compared to where productivity is now. For example, productivity now is at around 0.3, 0.5% in Europe. Well, I think that in 10 years, it could be at around 1.5% in 10 years. And of course, then changes all the world, and all the problems, I don't say are going to be solved, but they're going to be much easier to be solved if we have a little bit of productivity.
Quick break here. This episode is brought to you by West Red Lake Gold Mines. Now, if you know nothing about West Red Lake Gold Mines, let me tell you one thing. This company was founded on the back of a transaction where they purchased the Madsen mine in northwestern Ontario in an area called the Red Lake Gold District, which to date has produced around 30 million ounces of gold from some of the richest gold deposits in the world. Now, what they paid for this mine versus what they got has led legendary mining entrepreneur Frank Giustra to call this transaction the deal of the decade. And Bob Moriarty, founder of 321 Gold, was recently on my show calling West Red Lake Gold Mines one of the 2 most undervalued gold companies in Canada. If you're curious why these individuals are so excited about West Red Lake Gold Mines, hit the link below to learn more. Now back to the episode.
Great. Philippe, your thoughts on the investment implications of this trend?
Yeah, it's clear from an investment point of view, there is a lot to unpack here. And now let me elaborate for a second on the AI thing, and then move once again to commodities, because I think there are a lot of interesting links to be made as well. Now, first of all, a question we get very often is AI for real? There I'm going to be fairly brief. In the book, you have it there. We mentioned about 150 other books. So if you steal from one person, it's plagiarism, and that's illegal, and you can be fined or put in jail. When you steal from a lot of people, it's called research. So for innovation, we took a lot from Stephen Johnson, where good ideas come from, and his main ideas on innovation. Look, what do you need for innovation? You need smart people playing with components, but you need the components on the table. So what do you need for AI? Well, you need, first of all, you need a lot of computer power that we maybe did not have 5 years ago, but we have today. Maybe quantum computing, that's maybe an idea for the future as well. And you need, of course, big data, ways to store it, ways to manipulate it, and so on and so forth. So let's assume, and I'm fairly positive on that, okay, AI is for real. Now, how do you invest in that? Well, if you believe the market, by NVIDIA, by the Magnificent Seven, all these guys have been going up like crazy. A lot of the return of the S&P 500 and also the MSCI World, because the US is 75 or something, even more percent of the MSCI World, is in these stocks. Now, the only point that I want to make, I want to believe this because these companies have monopolies. They are very powerful. They're very strong. So they can buy whatever they want. They have a lot of cash. But in history, typically, when a new sector emerges, when a new industry is being born, well, typically you have new players. We saw that in the internet space, 400-500 companies went public fairly fast. Most of them went belly up, and we were left with the Amazons. We were left with the Googles and the Metas and so on, and that are the leaders. Now, if these are the leaders of the AI revolution, it would be the very first time in history that is the case. Now, in the portfolios, we try to have a balance because we cannot afford not to own them. We have seen in 2023, it's fairly painful not to have them. So you have them in the portfolio, but that's where commodities and other stuff comes in. You clearly have to look for other players as well, because if Koen is right, and he sometimes is, he often is even, not always, but often still, that this productivity is going to increase somewhere, well, all the AI story should move from the technology space towards the entire economy to create this innovative miracle, this productivity growth, and so on. So that's the move to the chemical sector, that's the move to the steel sector, it has to move everywhere. And what we do, we cannot afford not to own these big tech companies, but we try to find players that benefit also from the AI revolution and that have not the lofty valuations that NVIDIA and then other players have. And then you come to the more classical companies, but then you also come to the energy space. because energy stocks, petroleum, gas, and so on, is about 4% in the market cap of the S&P 500 today. It used to be 12. So I'm not saying I have to go back immediately to 12, but go to 6 or 7. There is also some upside. And if you know, I am not even talking about Bitcoin mining, which consumes a lot of energy. But even if you run a search on ChatGPT, it costs you about 10 times the amount of energy than a normal Google search. So the world will need a lot of energy, the world will need a lot of electricity, and it has to come from somewhere. So investing in energy, classic energy, but also alternative energy, I think is a very good idea. Coming back to this story of innovation, once again, I'm a big bull on this commodity space. I think this is going to be the largest bull market that the world has seen in maybe 100 years' time. But of course, innovation has the potential to take away a little bit of that in the longer term, not in the short term, but in the longer term. Because if you find new ways to recycle, if these new wizards find out new ways, and we all saw what happened in nickel, all of a sudden in Indonesia with Chinese money and with Chinese technology, they have a new process where they can process lower grade ore, also oxides, which, as you know, is complicated. So all of a sudden they have a new way of doing this, and all of a sudden you have too much nickel in the world with huge implications. And these things will happen from time to time. So that does not only mean that commodity prices will be higher, but they also will be more volatile at a certain moment in time. These things can happen. If you think like this about the oil market, for example, everybody dislikes shale. It's very polluting. Everybody detests it. But it's about 7 million barrels a day, even more, in a market of 103.5 million barrels a day, demand and supply. Well, we know that 1 million barrels more or less makes a huge difference in the price. So where would the oil price be if you did not have that shale oil? And I'm a big believer that, in a way, shale oil is not too far from its maximum supply. It has been going up. It has been going up way more than people initially thought. But the most important basin, Permian Basin, is clearly topping out, I have the feeling. So eventually we could also see higher oil prices, which will be good for the energy complex as well. So I think indeed we cannot afford not to be in this AI story, but I think we should be able to look a little bit further, look at stuff that is very cheap. And in my mind, energy, and we will come back to the metals and the copper and so on later on in the program. But of course, in copper and so on, there is also a lot of opportunity, because if you want an electrical revolution, well, you will need these materials. There is no way around it. So, but that's the main idea. Innovation as the potential to maybe reduce a little bit the strength of the bull market, but before you have these new things, it will be a couple of years, and for the next couple of years, a lot of these things will be in deficit, which means that the prices will be way higher. But I'm hopeful. Like I said, I'm a big bull on this commodity story. I hope I'm a bit wrong, because the more wrong I am, the better the world looks. But we will have to see.
Yeah, that was very interesting that you touched on traditional energy, oil and gas as well, because we're going to jump to the energy transition now as one of the other trends. But I do agree that there's a huge opportunity there in hydrocarbons as well. Koen, talk to us about what you're seeing when it comes to the energy transition. This is a contentious topic on both this program and my own program, Commodity Culture, because I've a lot of people on who think that wind and solar in particular is largely government subsidized, which is what has caused a boom in that industry. And it's not necessarily because it actually works, obviously a much lower energy density than something like nuclear energy, which I think is one of the much better solutions to having a carbon-free energy source. But I'd love to hear your thoughts on the macro behind the energy transition, and then we'll turn to you, Philippe, once again for the investment implications.
Yeah, if I look to climate transition and if I look to the energy transition, I just can see that we're way behind where we should be. If you look to the climate action tracker, what they say today is that if we implement the current policies, then by 2100 we will have an increase compared to pre-industrial times, increase of 3.2 degrees Celsius, which is of course disastrous. Now, it improved lately, and we have made quite some strides forward. Why? Because of the war in Ukraine, because everybody wants to be independent with regards to energy. And so you have seen huge investment by Europe, the Green Industrial Plan. Then you have seen Inflation Reduction Act. You have seen in Japan the Green Growth Strategy, and so on and so on and so on. And the economist, for example, says, yeah, okay, we have taken a step, we have taken 10 years 10 years forward in around 1 year because of this because of this war. So we've invested hugely, but I think for the moment we're away from where we have to be. I think for the moment we invest around $2,500 billion a year in the energy transition, in the climate transition. We should, according to the International Energy Agency, come at around $5,000 investment per year around 2030, then stick to that amount for the next 20 years, and then we have a chance of, let's say, limiting the increase of temperature to 1.5%, to 1.5 degrees. So we're way, far away from that. So there's still a huge investments to make. Now, who is going to suffer most macroeconomically? Sadly, that is, of course, again, the most poor countries, because the most poor countries are as well the most vulnerable countries with regards to the increase in temperature or not having any water anymore. And that is, of course, a shame, because they don't get the money that they need, neither from the industrialized countries. So that is one element that needs to change. Second element, what you see as well from macroeconomic implications, is that as well on the business side, there are going to be huge consequences. There are going to be a huge amount of stranded assets. And the more that we wait, the bigger this amount of stranded assets that you can't do anything with it anymore. A certain point in time, you have these plastic bags. You won't be able to use these plastic bags anymore. So all the companies that are making these plastic bags, they're gonna go broke. And there has been a calculation by the Bank of England to see the amount of stranded assets in the electricity companies worldwide. And they say if we do it very smooth and early, this transition, if we let's say increase carbon taxes, which are on average $5 per ton today on a global scale, if we do it very easy and we go next year to 7 and then to 8 and then to 10, and I know it's an illusion because quite a lot of countries don't even have a carbon tax, but if we would do that, then we could limit the stranded assets to around $800 billion if we have to do it late and very fast. Because all of a sudden we see that we had a big thunder and storm yesterday here. But if that's going to be our daily life, because the CO2 emission is that high that we've created something that we can't control anymore, then all of a sudden you have to start to stop emitting all of a sudden this CO2, this carbon, and then you have to increase all of a sudden your carbon tax from $5 per ton to $100 per ton. If that happens, of course, then you're going to have stranded assets 3 times, 4 times more. So we have to do it smoothly and we have to do it very fast. And there are going to be quite a lot of companies are going to be hit. Of course, the energy intensive companies are going to be hit. And that means, the companies are going to make steel, the companies that are producing concrete and stuff like that, they are going to hurt the most because they use the most energy. That are the companies that are going to hurt the most. I think as well there are going to be winners between these companies, because we're going to go from a consumer-driven economy to an investment-driven economy. And so this consumer-driven economy, it was great until now, but now we have to do huge investments in energy transition, in mitigating all the effects of the increase in temperature. And so these investments that are needed are going to be so huge that the companies that are going to do these investments, like bagger companies, I'm not going to talk too much about examples and everything, that these companies are going to profit from the investments that are going to be made by governments, by companies, in order to install renewable energy, in order to mitigate the effects of this increase in temperature, and so on and so on. And then the main element, and there I go a little bit on the train of Philippe, and so I'll give him pass on the word in a minute, is that if you look to the current rate of production of some important metals compared to the demand that there is going to be because of this energy transition, then you see that we have by far not enough copper mines, that by far we don't have enough silver, by far we don't produce enough nickel, vanadium, and all these things to be able to satisfy to all the demand up to 2050 for copper. You need to open 200 copper mines from going from today up to there. So this means that it's only in 15 years that you will have the first kilo of copper delved if you open a copper mine today. So this means that I really concur with Philippe that we will see some huge increases in copper prices and in quite a lot of other prices, because these metals are not there. And on top of that, and then we come to multi-globalization, but we come there in a minute. On top of that, quite a lot of this production and the refinery of these metals and other products is done by China. And so if we're going to annoy China a little bit more with putting import tariffs on electric vehicles, sooner or later China will say, sorry, but you don't get any vanadium, you don't get any cobalt, you don't get any graphite, and this will increase as well the price of metals and other prices. But I leave that to Philippe, because otherwise he doesn't have anything to say, and he wouldn't like it, of course. So Philippe, please.
Yeah, and also, Philippe, I'd like to get your thoughts on the nuclear energy side of the picture when it comes to the energy transition, and your thoughts on uranium as well, if you could fit that in there.
Yeah, that's also a big bull market now. Koen has talked a lot, so when you're on the road with this guy for a long time, you see that sometimes you have to stop and he talks a lot. but he said some very sensible
You can't
things.
do it now, eh?
No, yeah, very simple as well, but also sensitive things. Now, the point is, like you said, Jesse, you have massive investment in alternative energy, and it will be subsidized to a certain extent by governments and so on. So I think the sector had a very bad year last year, but now it looks, when I look at the chart of some of the solar players and so on, they look like they're bottoming out, so maybe the worst is behind us. They were also on the cover of, was it Business Week or Barron's, where you had the windmill that was totally broken down. Well, I love that when that's on the cover, because it means typically that the end is inside of the pain. So that's good news. So we have to invest in these things. Now, I don't know, I've not seen all their shows, I've seen a lot of them, but I don't know whether you already had Adam Rosenzweig on the show. He's one of the, if you don't have
not on this show, but I've had him on my show.
And otherwise you should have him again, because he's one of the big experts on this. And we borrowed the idea of EROI from him in the book, and where you say everybody knows the return on investment, but you have also an EROI, an energy return on investment, which means if you take a spear, you take your tribe, you hunt a mammoth, you kill the mammoth, you cut him to pieces, bring him back to the village, cook him, eat him, digest him. What does that cost in energy, and how much you get out of it? And then he argues, and I tend to agree with that, because there are figures that are well documented. We lived until the Industrial Revolution, we lived on an EROI of 5. And that does not look too bad, because that's 500%. If you can make that in an investment, everybody, I think, would be fairly happy with that. But an EROI of 5 means the world that we had for thousands of years, a population that doesn't increase much. From time to time, you have famines, you have some philosophers, from time to time you build pyramids and so on. But if the average is 5, and you have a pharaoh or you have a king or an emperor who wants to live at 5 million, well, it means that you have armies of slaves. You have one city of 1 million people, sometimes Athens, sometimes Rome, and so on, but one at a time. And it only works if they can take all the assets from all the other ones for the rest of the world. And typically the rest of the world is not happy with that for long. So you have issues. And then you go to coal, which is, of course, very polluting during the Industrial Revolution. You go to an era of 15. And then a couple of 100 years later, you go to oil and you go to an era of 25. And each and every time this is polluting, but still it makes you the possibility to build Wall Street, to build Hollywood, to have ports and harbors and roads and trains. And it goes on and on and on. And where you're going, and you know this figure as well as I do, if you look at uranium, well, there's an era of 50. Now, we write about this in the book, and I've left in the middle. I've not really said how much solar and wind have. But suppose it's less than 25 and certainly less than 50, well, this is the first energy transition in history that you go to a lower EROI, which means you have lower welfare for the people. And okay, we have the 5 chapters. Koen already pinpointed the conclusion, but the point is these chapters are also related, because if you lower the living standards of the people, they will go to more extreme parties. You will vote away the sitting governments. So that's what's happening in the entire world. So as a bank, as BNP Paribas Fortis, we're way behind and we believe in the energy transition. We try to support that. We have portfolios that try to play this, but still we have to do this in a realistic way. We need these wizards to basically find the new batteries of the future, improve the grid to get this EROI of alternative energy as quickly up as possible. That's the only way that this is going to work. So that's extremely important. Then coming back to what Koen says, in the book we have a chart that's not a BNP chart, but that's a Bloomberg consensus of the demand for metals from 2025 and 2050, I believe, where you see this wall of demand. And of course, if you make a prediction over 25 years, you know we're going to be horribly wrong on the length of the bars, but still there is a wall coming. It will be a very big wall or a big wall or a huge wall, but it will be a very big wall. Now also the composition of the bars is not always clear, because nobody knows what the batteries of the future will look like. So it's very well possible that we replace cobalt by nickel. It's possible that eventually we even take lithium and we have sodium instead. But there will be demand, and if in all the demand in the bar, I'm the most confident about copper, because if you want to take electricity from point A to B, at the moment it's still copper. Maybe they invent something new. I don't know when. I don't see it on the horizon, but it's always possible. But that demand is there, and then, like Koen says, because there is a demand story. But even more importantly, there is the supply story, where you know that we don't have enough copper mines. And we can hope that a lot come from recycling. And once you have an installed base of electrical vehicles, you will be able to take some of that back into the system. But for the time being, I see a lot of these markets being in deficit. And that's also the same for uranium. Uranium is slightly different. But what you see, the problem is an average mine is 15, 16 years to open. Try a uranium mine, well, the number of permits you need for that is even bigger. So US is only able to produce enough uranium at the moment to have 1 reactor turning, and the rest has to come from Kazakhstan for a large extent, some from Canada, some from other places. But everywhere in the world, new reactors are being built, and then you have not an increase in supply. Now, the last bull market we had in uranium, help me out, is about 30 years ago or something, so it's already a long time ago. But then the worst stock went up 15-fold and the best stock went up 30 or 35-fold. I don't think it's going to be this spectacular this time, because you have Kazakhstan, which you did not have back then, which was still quite a bit of supply, but still these things could go up quite a bit. And a stock like Cameco is one of the best producers. They mothballed Cigar Lake some time ago, but that's running again, I believe. So I think that there is also a massive opportunity. So I always say to our clients, which are very often also companies, I'm totally on board with the idea that you hire somebody for AI. Even if you don't exactly know what they have to do, they have to follow courses, they have to study just to be in a good position to benefit from this when it materializes. But if I were a company in the commodity space and commodities were my input or even my output, I would hire somebody to follow the commodity market, because that's where it's going to happen. If you can find somebody, of course, because nobody of the young people is graduating. They close down all the schools. I know people in the sector, they're 70 or 75. They get calls from headhunters. They say, we know you're 80, but can you please come and work for us because we cannot find people. So this is a space where a lot of things are going to happen. It's a demand story, but even more a supply story. And one of the largest investment opportunities I've seen in my life.
Yeah, fascinating breakdown. Let's turn now to multi-globalism. In the interest of time, we'll actually end on this trend. And then for debt and aging and demographic transition, of course, you can get the book, and we're going to talk about that at the very end as well.
That happens all the time when Koen talks too much.
No, I mean,
it's already 3 is good.
I've loved the conversation so far. I mean, it's been packed with information. So very grateful for having both of you on. So let's talk about multi-globalism. Koen, what is the macroeconomic implications of this trend?
Well, if we look to multi-globalization, it's a new word because we don't think it's deglobalization. It's not deglobalization that's happening, it's multi-globalization that is happening. Now, what we've seen is that there is a hyper-globalization up till 2008, and then you had slow globalization, in fact, from 2008 on. And now from slow globalization, it's going into multi-globalization. And why do I talk about multi-globalization? Because I see that, first of all, the companies want to simplify their supply chain. Why is that? Because they've seen as well there is a limit in the global value chain. It's too complex. Second of all, you have all these trade wars, and with Trump maybe coming back, then I think these trade wars could increase even more than they are today. Plus, you see as well that it's not only China against the United States, it's now as well China against Europe, and it's going to worsen, I think, in the coming years. Now, what is the reaction of China? First of all, instead of made in China, what they are going to do is do something like owned by China, and this means they're going to have more and more of these factories in Europe. So instead of having import of Chinese products, they're going to produce them here, which is a little bit double, because from one side, it's okay for the European governments because they're not going to be too many people fired. From the other side, if the Chinese decide to go away, then you don't have anything anymore. So it's a bit double. A second element, and that is where multi-globalization comes in, is that if you followed the Trump war, the Trump trade war in 2017, what happened is that all of a sudden, instead of China exporting to the United States, all of a sudden China started to increase their investment hugely in Vietnam and some other countries. And all of a sudden you saw that the exports from Vietnam to the United States exploded. So 1 + 1 is 2. So instead of going straight to the United States and paying their import tariffs, they just invest they still make the principal components. Then they invest in and they put on factories in Vietnam or another country, and then these countries, they produce the final product, and they then export these products to the United States, which is of course very painful for the United States, because first of all, it circumvents these import tariffs. Second of all, these countries, and I'm talking about Vietnam, Mexico, South Korea, Philippines, Thailand, India, South Africa, they like, of course, what China does. And so they are starting to have alliances more with China than with the United States. And that is, of course, a double problem for the United States in the long run. And so this is not deglobalization, but this is multi-globalization. And I think it's very good for these countries who lay in between, because they can develop themselves. They're going to increase their wealth, and it's great for them. From the other side, yeah, it's not good for climate transition. That's for sure, because you have a stop in between. And it's not good for the United States neither, because there are more and more alliances with China and these countries, instead of the US having alliances with these countries. But this is a huge development, which, yeah, will push down a little bit. If it goes too much, yeah, it will push down a little bit productivity. But of course, it will increase inflation again. As well, this multi-globalization and its trade wars, yeah, it will have an effect as well on the price of these commodities, because as we said before, yeah, if you annoy China too much, they will say as well, okay, a trade war is one thing, but the climate transition, sorry, you don't get these vanadium and all these metals anymore. But there again, I leave it to Philippe to dive deeper into the consequences and investment consequences, because there are, of course, quite some investment consequences as well on this major trend.
Yeah, Philippe, do you see more of what Koen was talking about occurring, China and maybe even some other countries restricting access to their commodities, whether that's from a strategic geopolitical move, whether that's for their own financial purposes? What do you see happening with that particular trend?
Yeah, absolutely. So the world that Koen describes is a world that's very well described also in the book. The Fourth Turning is here by Neil Howe. The Fourth Turning was written already, I think, 30 years ago. Back then it was still Neil Howe and Mr. Strauss, but unfortunately he passed away, so he did an update on that. And if you look at the world, it's not a book, I don't know, it's not a book to read at the swimming pool, not under the Christmas tree. So you have to find a moment in the year that's very depressing already, because it's not a very optimistic book. But if you look at the world of the conflicts that we have in terms of the wars, in terms of the conflicts within countries, with the extreme parties gaining, the sitting parties being voted off, and so on, well, that's typically a fourth turning. And fourth turnings together always 80 years, and that's a very hard message. But why it's 80 years? Because it's a human lifespan, and basically all the people who have lived through the previous conflict and wars have to be dead to start again. And unfortunately, we're there, and that's the time we have to go through. In 5 to 10 years' time, the young wizards will find a solution, and then we will have a first turning again. But this is a fourth turning, so that's very important to look at. Countries playing against each other, and also within countries. And because you have the pressures within the countries, the probability that you have fights and wars and hot and cold wars between the countries also increases. Now, from an investment point of view, that's very important, because you used to have a world that was centered around the United States. It was a unipolar world, the United States policing the entire world and making sure that the oil supplies from the Middle East were under control. Now they have their own energy, so it's less necessary than basically before. And we used to, when we talked about the emerging markets, we would say it's the emerging market complex, and we would treat them as one entity, even with China within it, even though it's in terms of cycle and in terms of maturity of the economy, something totally different. But today we know there is a US bloc, there is a Chinese bloc, there is a Europe that should talk with one voice to have something to say in the world. It's very complicated, because in the fourth turning, that's not going to happen. Then you have Russia, which is not a really economic power, but still a military power. And then you have these countries like Koen described, India, Vietnam, Bangladesh, Mexico, so countries that are really benefiting and are managing to position themselves between it. Now, to your question, basically, we will see more protectionism. I saw it today or yesterday on social media. Canada is also restricting the possibility of people buying their companies in copper and so on. So everybody is basically protecting their own turf. China is, as we know, very active, not by coincidence, in Africa, also in Latin America, but especially so everybody tries to secure these supply lines, and that's very important. So if you restrict this, you will in a way reduce the premium, because it's very more difficult to buy these Canadian companies. And then, of course, the takeover premium will be maybe a little bit less. That's built in the stock. Now, on the other hand, these things are so cheap that it does not matter because it will go up way more anyway. But also, because the world becomes more complicated, because the supply chains become more complicated, it becomes more difficult to find places to source your commodities. Places that have good jurisdictions where you can still mine, where you have laws in place to protect these things and so on, will get a premium. Because if it becomes way more difficult to, once again, Canada, if it becomes more complicated to get nickel and all stuff in Asia and in Africa, well, a neighbor, stable political neighbor, I think these companies will get a higher valuation. Some very interesting things are happening, and not to end this badly and to say something very nasty, but you also know that the Second World War was also about resources. The way that Japan entered the Second World War was in a way because they had no access to commodities anymore. So this is potentially very dangerous. But once again, and this is maybe the bottom line and maybe one of the recurring themes in the conversation that we had, the commodity space will be very volatile, the prices will be mostly higher, and we have to pay close attention to this because we almost slept through it for the last 30, 40 years and nobody is paying attention. But I think in 2-3 years' time, what we talk about today will be on all the headlines, and maybe then it's too late as an investment opportunity. But I think the opportunity is clearly there today.
Well, gentlemen, this has been a fantastic conversation. Philippe, you sent me this book, The New World Economy in 5 Trends. And normally when somebody sends me a book in the mail, I think, oh, maybe I'll look through a little bit of it, see how it is. I was quite blown away by how well this book is written, how fun it is to read. You guys really make it fun in a lot of different ways. So where can people get the book? And anywhere else you want to direct people online when it comes to both of your work?
It is available on Amazon, UK, US. Unfortunately, at the moment, it's sold out because we were so lucky, we were happy, and thanks to Koen, to a large extent, once again, we were in the summer reading list of the Financial Times by Martin Wolf. So yeah, if you get there, you're sold out in 2 or 3 days, and then but basically the books will be back. They promised me in the next couple of weeks, so they're available online all everywhere, and there is also a Kindle version of it. So we're not getting rich by writing books, as you maybe know, but we're very happy with the reception, very happy with the opportunity we got from you today, and very happy that the people like the book because most of the feedback we get is fairly positive. So that's good news.
Fantastic. Well, gentlemen, thank you once again for coming on the show. I'll put a link in the description to the book so people can pick that up, and definitely enjoyed the conversation today and hope to do it again.
Thank you, sir.
Thank you, Jesse. Thank you.